Hello, good morning. I hope we are all fine. Yes, I'm back here again. Sorry for the late update. And I had some small issues with my laptop. Just when I was about to record this video, I don't know, the laptop automatically went off and I needed to fix it. Yes, I was so confused because I was like, hey, so if this laptop doesn't work again, then it means I have to buy a new laptop. Or how will I be able to be uploading videos for those who need my help? But thankfully, my repairer was able to fix it with a considerable amount of 400 cedis. Yes, it was very serious. Something was bent on the board. So I don't know. I'm not really putting pressure on this laptop. I don't know why. I'm sure it's because I've been using it for long, since 2017. So I've been using this laptop, so you can just imagine. All right, all right, all right. Welcome back to this channel. Kindly like this video and also share it to your friends who might need this help. Jesus. All right, so today we'll be talking about taxation tutorial set 3. I think after this, I'll be focusing on the other courses. Yeah, yeah. I'm so tight. I wish I'm even done with everything, but empower. So we'll be talking about tutorial set 3, which is more of capital allowance. Remember, in our lecture video, we said that capital allowance is basically like depreciation of fixed assets, right? So that's the same thing here. So the depreciation that we normally do in our financial accounting way back in level 200, we are going to apply some of the concepts here, but just that at this side, we need to apply some technical knowledge and stuff. So we are going to do this straight away. Let's get into it. So to begin with, I want us to revisit our classes on assets so that we will be abreast and also remember our assets and their classes. So now let's talk about this. So in class 1, we said that in class 1 asset, we said that it is made up of computers and data handling equipment. So beside computers, which are specifically named in the Act, other assets that can belong here are only described as data handling equipment. So when you see computers or data handling equipment, then you can put them in this class, right? And they said that this can include machines. So at the time of the Act, this was what was there: machines, calculators, time recording machines, typewriters, right? So if in case you get a question where you get any asset that is like a data handling equipment, but it's not in here. For example, we cannot see photocopier machine here, even though it's a data handling equipment, but we cannot include them here. Television can also be a data handling equipment, but it is not in here. So we don't put it in here, right? So after solving our questions, right, the tutorial set will really understand. So the Act provides for 40% as the rate for capital allowances on class 1 assets. So if in case later on the Act includes photocopier machines and stuffs, then we bring them in here. But at the time of recording this video, these are the assets that can be included here in the data handling equipment, right? And it also uses what? The rate is applicable to the book value or the written down value of the asset. What it means is that we are using what? Reducing balance method. Remember, in the reducing balance method, cost minus depreciation, then we get our net book value. So the net book value is what we apply the percentage on. So here to the same thing, our cost minus our capital allowance will get us our written down value. So that's basically the same thing here, which is applicable to pool 1. Let's go to pool 2. So class 2 assets or assets in pool 2, right? They include automobiles, buses, minibuses, good vehicles, right? Construction and earth moving equipment, heavy general purpose or specialized trucks, trailers and trailer mounted containers, plant and machinery used in manufacturing, cost of capital nature, incurred on business of timber, concern large-scale rubber, oil palm, or other long-term crop plantations. And this, the applicable rate here is 30% on the net book value, and it is also what on the reducing balance method, right? All right. So we have class 3 also here, which is the categories of depreciable assets placed in this pool are railroad, cars, locomotives, and equipment. Vessels, these are more or less like water transportation items. So water, barges, tags, similar water transportation, like things that works on water. Then aircraft, any business involving the use of aircraft owned by a person carrying on a business whatsoever. Specialized public utility plants, equipment and machinery, office furnitures, and office furniture, fixtures and equipment, and etc. So any depreciable asset not included in other class. Remember, I said that photocopier machine was supposed to be like fancy data handling equipment, but it wasn't included there. So because it has not been included there and it doesn't really have any class, we will include it in what? A class 3. This group has a rate of 20% applied on the net book value. So it also uses what? The reducing balance method. All right. So now this is applicable to the class 1, 2, and 3 assets. So when assets are placed in this pool, they lose their identity. So they are all combined as one. Then cumulative written down value from the basis of the depreciation. Consideration received from sales of the asset is deducted, right? More or less like the normal depreciation. When you sell something, we deduct it from the written down value of the asset. So, but not more than the written down value of the pool. That is, value in excess is credited to the income, right? So we don't credit more than the amount to the system. So if all the assets in the pool are realized, then the capital allowance is granted for any residual value. If at the end of the basis period, the written down value of a pool is less than 500, then we grant it as what? A capital allowance. So if in case you get you lesser, then you have 400 Ghana cedi as your written down value, then we also grant that 400 cedis as a capital allowance to the already capital allowance there, right? So the cost base of a road vehicle other than a commercial vehicle shall not exceed 75,000. This is what normally confuses students, right? So non-commercial vehicles, right? When, according to my research, non-commercial vehicles are vehicles that are not used to transport goods and services, right? And it carries less than 13 passengers. So normal saloon car, normal car that carries less than 13 passengers is a non-commercial vehicle. And also a vehicle that carries less than half a ton. So when we say half a ton, it's more or less like the big fridges in our home, like 5, right? So if the car cannot carry it, then it is considered as a what? A non-commercial vehicle. And irrespective of the amount, if the amount is 100,000 or 500 whatsoever, we bring it down to what? 75,000. That is what we'll be using for our calculation. So if the basis period is less than 365 days, the person is not granted full depreciation for this period. Keep this in mind. We'll talk about this and we'll use it. The capital allowance has to be calculated according to the following. So we'll talk about this. All right, so let's look at pool 4. So assets in pool 4. Assets class 4 is made up of buildings, structures, and works of permanent nature. These assets, irrespective of the kind of industry, are used in, irrespective of the industry they are used in, are of perpetual economic usefulness. So items that will be there for a very long time. This includes shops, factory buildings, warehouse, and stores. The rate is 10% and it's on a straight line basis, right? So the same thing applies here, where whatsoever. Then Asset class in pool 5, right, consists of intangibles like copyright, patents, right, trademarks, and etc. Right. And um, like capital allowance are based on straight line principles, and the cost of the assets over the useful life, the same thing. All right, all right. So now let's go straight to our tutorial set. So in tutorial set 1, this is what we are having here. Kama Limited commenced business on March 1st, 2020. One key thing you have to take in mind when answering a capital allowance question is look at the basis period when it comes to the first year. So the first year, you always look at the basis period. So the basis period for this particular business for the first year, right, will be, so you see, you say prepare accounts on December. So first year will be from 1st March up to 31st December. So you have to take the days into consideration. So any assets you bought in here, irrespective of the dates they were bought, will be granted capital allowance within this basis period. So look at this. This one was bought 15th October 2019, right? But it will be granted capital allowance within this basis period. This, for example, was bought 10th January 2020. Forget about everything. It will be granted capital allowance within this basis period, 1st March to 31st December. This one was bought on 30th September 2020, which in the normal sense, it will be like it worked only September, October, no, 3 months, but still capital allowance will be granted within still the basis period, right? So what's basically what it means here is that even if the asset is bought on 30th December and was used in the business on 30th December, then still capital allowance will be granted within this basis period. Keep this in mind and don't get confused. All right, so this was the assets that were available and their date of acquisition, which wouldn't really matter. What really matters is the basis period for the first year. But the preceding or the next years, we'll be granting capital allowances for the full years because that's the number of days in that it will be used, right? Unless, let's say, the business ended before the year end or the business collapsed before the year end. So the following assets were acquired by the company during the year 2022. So just as our normal depreciation that we used to do, when you buy an asset in this capital allowance, you include it before you charge a capital allowance. And if you sell any asset too, you subtract it before you charge any capital allowance. That's what it means here. So any asset, irrespective of the month it was bought, you add it before you charge a capital allowance, and irrespective of the month or the whatever it was sold, you subtract it before you charge your capital allowance. So the following additions were acquired by the company. Let me check if I'm recording. Yes, I'm recording. Yes, sir. Didn't. So, so the assets were acquired by during the year 2022, year of assessment. This is the amount for computers and accessories, and this is the amount for office and equipment, right? So, on the same year 2020, so just don't look at this thing, it doesn't really matter. The Toyota saloon car was involved in an accident and was completely unrepairable. The company received a compensation of 120,000 from the insurer, right? So we'll also delve into that. So the following profits were declared by the company at Legon Office of Ghana Revenue Authority for the first 3 years of assessment period. So we have 600,000 here. This is for the first year, 31st December 2020. Year 2, this one was 1.5 million, and then year 2, this one was 2.68 million. So now they are telling us to compute the capital allowance and accessible income for accessible income of the company for the relevant years that we've been given this profit. So look at it here. Our main aim is to what? Just identify what is supposed to go in pool one, what's supposed to go in pool two, pool three, pool four, and pool five. Then straightforward, we know our percentages, then we kickstart. Right. So looking at this, we have computers and as computers here, which will be what? In pool one. Annotate. Computer will be in pool one. And then for pool two, you have plant and machinery here, pool two. We will also have Toyota Saloon Car. Toyota Saloon Car in pool two. And then we also have motor van in pool two. Right. Then office and equipment will be in pool three. Right. Then industrial building will be in pool four. That's why I said let's go over the classes of the pool before we enter here. Right. So once you're able to identify this, the rest is done deal. Now you calculate your basis period. So basis period will be from basis period for this particular distance will be from 1st March to 31st December. Right? So if you really want to count everything from March to 31st December, it is it will be really like long. So what I'll let you do is just 3, 6, 5 minus, we have January will be 31st days, 31 days, plus February, because we are using 365, we don't consider the leap year, so we use 28 days, so 28. Right, so we have January and February out of this, then we'll be getting 31 plus 28 is going to give us 59. 365 minus 59 is going to give us 306. So our basis period is going to be 306 days. So whatever we will get here is going to be whatsoever the capital allowance times 306 all over 365. That's what we are going to do straight from here. Simple. Once you dissect this, you are done with the question. Keep in mind that Toyota Saloon Car has 180 Ghana cedis here. But Saloon Car is not a commercial vehicle, right? And it cannot carry 13 people. I just said you go in voter rating. The last time I visited voter rating, some small car that they were using for a taxi, hey, the back was carrying like 5 people. Hey, and you can't complain because the cars are like, they are not many. So the 5 was carrying like 5. If the people are tiny, they will manage and put like 6 people there. Like 4 people or 3 people will be in front. So I don't know whether that car is a non-commercial vehicle or a commercial vehicle, right? So here, even though it is 180,000, it will be what? 75,000 for this one. But we assume that motor van is a commercial since motor van is considered as a very big vehicle, right? So we consider that one. So here will be 75,000. Once you're able to get this, you are done with the question. Straightforward, right? Let me quickly clear this. Let's go into the answers. I've explained all whatever we are going to need as an answer here. So let's go straight. So in pool one, right? In pool one, we recognize that computers are here. Computer was what? 80,000. So that's the 80,000 here. That's the 80,000 here. So basically, this is the 80,000 here. So pool one has an asset value of 80,000. And that's what we are having here, right? And then pool two will have the plant and machinery. Adding to this, we'll have the Toyota saloon car and then also the motor van. The motor van, we keep it as the same as we know already. And then this one will be changed to what, 75,000, since that's the max. When we add all of them, this is what we are going to get here. 1,895,000. Then pool three is going to have office equipment. That's what we are having here. And then pool four is going to be the industrial building. That's what we are having here. Right. So I told you to take note of the basis period, right? Which is from 1st March to 31st December. So we are going to have 306 days, right? 306 days out of the 365 days. So basically, whatever you are going to do in the first year, right, will be based on the basis period. So first, this is 40%. 40% times this 80,000, right, times 306 over 365. So basically like this, right? So the reason 365 because it started from March up to 31st December. So from 1st January to 28th January won't be considered. So when we subtract 365 minus January has 31 days and then February has 28 days, we don't consider the leap year. So that's why we are getting 306. So once we do that, we come and then get this. We do same also for this, right? 30% times this, 30% times this, times 306 all over 365. We do the same thing also for this. 20% times this times 306 over 365. Then with this one, it is 10% on the cost, right? So we do the same thing, 10% times the cost times 306 over 209 over 365. Then we get the same figure as this capital allowance. So once we do for them, we are getting all these capital allowances. We add all of them to come in and get the total, right? So we do the same thing for this one. Remember, the next purchase or sales was made in 31st October 2022. So we have to automatically find our written down value for 2021 and then send it to 2022. So the following assets were acquired during 2022. So basically, we are going to do the same thing. Computer and accessories is in pool one. So we are going to bring this to pool one in our 2022. So let's just look at what happened in 2021. So 2021 will have a full year, right? It will start from 1st January and 31st December. So there wouldn't be any 306 over whatsoever. It will be running with a full year. So 1st January 2021 to 31st December 2021, we'll be having this written down value brought forward. Then 40% applied to this, 30% applied to this, 20% applied to this, and then 10% applied to the cost. Take note, this is for pool 4 and 5. They are applied on the cost. Pool 5 is on the estimated useful life, and then for pool 4 it's applied on the cost. Remember, so we apply the 10% on the cost of the building here, which is all 2.5 million. So 10% is now going to give us 250,000, right? This year we are not going to reapportion or anything because we are using the full year. So we take them out of the written down value. this will now become our what? Written down value carry forward, right? So this is basically it. Then we add all our capital allowance because that's what we need to compute our accessible income. Then 2022, I told you that in case there's any addition or like in case they buy any new assets or sell any new assets, make sure you treat the additions and subtractions first before you calculate your capital allowances. So basically, additions were here. They bought new computers and then they bought new office equipment. Here is pool one, here is pool three. So here will be added to pool one, and this is also what's added to pool three, right? And then a Toyota saloon car was involved in an accident, which was what, October 31st, right? And still, I told you that irrespective of the date, right, you will still take it out as a full year distance. So this 120,000 was taken out of the pool two because motor van is what in pool two. A Toyota saloon car is in pool two. So we take the 120,000 out, and then now this is what our balance to be left for our capital allowances, right? So this minus this is going to give us this. I remember that still, where is it? Still, for pool four, or land and or factory building will still be applied on the cost. So here we get 40% on this, 30%, 20%, and 10% on the cost. But these ones are on the written down values, right? So we subtract, and then this will be what our written down value to be carried forward, right? So now, we are told to what? Compute uh I thought to compute accessible income for the years, this 3 years. So period to 31st December 2022. Here was our profit. Here was our profit, 6 million. And then let me see. First, I realized I spoke and recorded everything without I spoke on how to do everything without recording. So bear with me. So here, our 600,000 is here. Then we deduct our capital allowance. Remember, the capital allowance is what we computed here. Here is it. We add all of them, and this is it. So we deduct it, and then we get you get a loss because the capital allowance is more than the profit. So there'll be a new, and remember the losses can be what carried forward for the next 5 years, right? So we carry the loss to the next year. Our next year's profit is 1.5 million. Then we deduct our capital allowance for that particular year, which is 719,760. Then we bring forward our tax loss, the loss in the previous years. Then in the previous year, then we bring it. This will be our total deductible amount. So we deduct, and then we get an accessible income of 644,080. Then for the year 2022 year of assessment, our profit is 2.68. It's 2,680,000, right? So we bring our capital allowance, then we deduct it, then we get our accessible income. So simple and straightforward, right? So in case you didn't get anything, you can comment or leave down a comment. Let me come and then explain further. So basically, this is it for question one. Let's quickly move on to question two. Let's quickly move on to question two. So for Fana Company Limited producers of special fruit juice. It started business on 1st January 2016, preparing accounts to December 31st each year. The company had constructed an office building and was put into use on 1st January 2016. The following are the capital allowance written down values brought forward from pools of assets as at 1st January 2017. right? So so all these items is what just the written down values, meaning that they've already deducted capital allowances from it. So pool one is having a 12,000 this thing. Pool two is also having 520,000. Pool three, 405,000. Pool four office building written down value is 540,000. And the patent was acquired in 2016 for 5 years, and it was having a value of 48,000, right? So basically, this is it here. We bring up since they didn't put this in pool four and they separated it, I also advise you do the same thing when it comes to answering it. So office building will be kept in a different distance, and then if in case there is any other asset that was purchased in pool four, right? For pool four, will also be treated as like slightly different. So that's what I did. So pool one, pool two, pool three is in a different table. Then office building, which was office building, factory building, patents and trademark is what also in a different building. It's in a different map or in a different table. So I'm coming. All right. So now let's look at the broad forwards. So pool one was what 12,000, which is here. Pool two 520,000, which is here. Pool three is also here. Then there was some additions, right? In the year 2016, 2017, sorry. All right, so let's look at the written down the broad forward two for building, right? Building here is for 540,000, right? But here the written down value is what? The cost is what? 600,000. The reason is because remember that the building was what? Was constructed 2016. So meaning that this thing has already been taken out because what we are having here is written down value. So meaning that capital allowance has first been deducted in the first year. Remember, buildings capital allowance are calculated on cost. So if we really want to get its capital allowance, we have to bring what? The cost, not the written down value, right? So if you want to get the cost, remember building is in what? Pool four, and it attracts what? A 10%, this thing, capital allowance. So if we want to convert it and then get the cost, what we are going to do is we are going to do this. Since it is 10%, if we really want to get them, we are going to do 100 over 90 times just 540,000. Then we are going to get 600,000. Right. So that's how we had this 600,000. And also patents is what? For 5 years. 1 year has already been charged. That's why we have this as a brought forward. So if we really want to get this, then we are going to do it like this. 5 years over the left. You see, it's 5 years and we've used one already. So it's left with 4 years times 48. Then we are going to get 6,000 or 60,000, sorry. So that's why we arrived here. So in case for the asset that are being done on the straight line, if they give you written down value, you have to convert them and get the cost. Otherwise, you get confused and then you get everything wrong. So we convert them and then we are going to get this here and then this here. Right. So now let's move on. So we were told that they acquired the following chargeable assets for the business in 2017. Right. So factory buildings they acquired. So that was the addition that is being done here. Then plant and machinery, 2.5 million. File cabinet is here. Electric ceiling fan, ceiling and standing fan. So first, let's just indicate um the pools so that it will be easy. So for pool 3 assets, um, so for pool 3 assets, we will have office chairs, pool 3, visitors chairs, pool 3, television, pool 3, photocopier. I told you that since at the time of the act, right, photocopier wasn't there, right? So photocopier will be included in pool 3 since it doesn't have a pool. So photocopier will be included in pool 3. LCD television is also what included in pool 3, even though it looks like a data handling equipment though. But it will still be what added in pool 3 since unless the art is being changed. So photocopier pool 3, motor vehicle pool 2, windows and split air conditioners pool 3, electric ceiling fan pool 3, power cabinet pool 3, plant and machinery pool 2, and then factory buildings pool 4, or you leave it alone, right? So that's what we are going to do here. So now factory buildings is here. This is the addition. This is what they employed in, or this is what they bought. We bring it in here. Then there were no additions on office building, right? So that's it. Then let's move to all right. So now we are left with pool 3 and pool 2 assets here, right? So for pool 2, we have plants and machinery and then motor vehicles. So when we add them, we are going to get 2.5 million times this 110 million. We get this, right? Then file cabinets and the family of them. These are all of them. So when we add all of them, this is what we are going to get for pool 3. Right. So this is the additions that were made in pool 3 during the year 2017. Right. Now, the following were disposed of in 2017 since they were not suitable for the company. Computer and accessories, 11,600, standing fan, 10,500. Right. So in 2017, this was the disposal. Right. Also, I told you not to really take, if in case they give you the date into consideration, but don't mind of the date. If the asset was even bought on 30th December, we assume that it has worked within the basis period. That's why say the basis period is really important when it comes to this. So it is the basis period we normally take into consideration and not the time the asset was bought, right? So in 2017, we sold an asset from pool 1. This is it. And then we sold a standing fan, which is an asset in pool 3. Here is it. So we subtract them and come and get our destiny. That would be what? Allowed for capital allowance, right? So for this one, we are getting what a capital allowance of the whole written down value. Remember, the law was saying that in, yes, it was saying that in the case where the written down value is what? In the pool is less than 500 after granting capital allowance, the balance is granted as what? Additional capital allowance. So here, the destiny is left with what? 400, right? We allow or we grant all of them as capital allowance. All right. Okay, where is it from? Okay, if all assets, yes, so that's it. Then here, this will be what? 30%. Remember, this is 40%, 30%, 20%, right? So we find 40%, a 30% on this, then we get this. Then we find our 20% on this, then we get this as our capital allowance. So remember, this was a full year something. So we would not apportion or do any 300 and something over whatsoever. So we had, for us to get a total here, we add all of these capital allowances and we get a total here, right? You get a total here. All right. So now let's take a look at the building side or the pool side. So in pool 4, for example, in the year 2017, this is it. So they added what? A building, which was what? Here is it. They added what? A factory building. 950, that's what we brought in here, right? And then remember, office building is being calculated on the cost. The 10% is being calculated on the cost before. So 10% of this 600 is giving us 60,000. 10% of this is also what giving us what 95,800. Remember, this is what over the useful life. So we divide this by 5. We divide the 60,000 by 5 when it comes to patents or intangible fixed assets. We divide it what over the useful life. So this was having what a 5-year lifespan. This was having what a 5-year lifespan. Where is it? A 5-year lifespan. So that's what we are having here. Divided by 5, we get this. So now we add all of this to. So now if we want to know the capital allowance for the year 2017, it is this plus this. And we get our total capital allowance for the year 2017, right? So now we go to the year 2018. In the year 2018, this is what they acquired the following listing. They acquired a Toyota Saloon car of what 70,000. And then they acquired what? A pickup of what? 95,000, and then LCD projector of what? 5,500, data handling machine, 36,000, truck and trailers, 54,000, and then trademark registered for what? 8 years. So let's quickly look at this and then identify our distance. So remember, this is what? Pool 2. This is pool 2. This should have been what? A data handling equipment, but at the time of the act, this wasn't there. So this was included in what? Pool 3. Data handling machine was in the distance. You can see it from here. Data handling was in what? Pool 1. Pool 1, data handling equipment is here, right? So it will be included. So data handling machine will be in what? Pool 1. right? And then trucks and trailers will be what? In pool 2. Then this one will be in what? Pool 5, right? So since you are able to get this, you are almost done with, you are done in pool. So now total saloon car here is going to be 70,000. Remember, here is also what? A pickup. Pickup is a non-commercial vehicle because it cannot carry a load worth of half a ton, or it cannot carry 13 passengers unless in some regions where they do impossibility. Right? So this is it. We change it to what? 75,000. All right. So yeah, 2018. We have 36,000 as an addition because that was the data handling equipment. Then you have pool 2 will have an addition of 199, 199,000, which is going to be the Toyota, which is 70,000, plus the Toyota pickup, the Toyota saloon car plus Toyota pickup. Toyota pickup is going to be changed to 75,000, plus the truck and trailer, 54,000, 199,000. So that's what we are having here. Then LCD projector, as I said, will be what? Into 3. That's what we are having in here. So we check if there has been any what? Sales, or there has been any disposal. So one of the cars, one of the vehicles was involved in an accident in 2018, and the company received 45,000 as insurance compensation for that year. So we will take it as a form of disposal. This is it. So we add, then we subtract before we calculate our capital allowance. So this is it in here. 40% on this is going to give us this. Then 40% on this is going to give us this. 30%, sorry, 30% on this is going to give us this. Then 20% on this is going to give us this, right? Then this is going to be our written down values. After subtracting, this is this from them. This has been taken out, this has been taken out, and this is it. Capital allowance questions are so easy. You just have to know where the asset falls into, and then you are done. So now, where is it? So office building, nothing was added in the year 2018. So our capital allowance was remain the same. Then what is the distance? Okay, this is factory building. Okay. Office building, nothing was added. Factory building to nothing was added. Then this thing is still based on what? The useful life. Then we what? Acquired a trademark of for 72,000, and it will last for what? 8 years. So 72,000 divided by 8 is going to give us 9,000. That's what we are having here. All right. So now the question is telling us to do what? We should determine the capital allowances for Kofana Limited for the year 2018 and then 2019. So basically, capital allowance for the year 2018. So 2017 year of assessment, capital allowance. So it is going to be 2017 is going to be this for the pool 1, pool 2, pool 3 side, plus this. It is going to give us 1240600, right? And then 2019, 2018 is going to be this. Plus this. Is going to equal to 2. So this is it. Right? The reason why I did it this way is because I did the pool 1, pool 3 in a different table, and I did pool 4 and 5 in a different table. So at the end, I need to add them. If I'm to squeeze all of them into one table, the figures will be what? Small, small. So I did it this way, and then that's basically it. So this is it for the question, the A part of this question. Now the B part is saying that indicate how the classes or pool system works with the treatment of capital allowance. So basically, they just want you to what explain what you've done so far in the form of how the pool works. So you see this is the summary description of the pool system. This is where depreciable assets of the same classes are put together for the purpose of capital allowance. 2, in the pool system, the identity of an asset is what is lost when they are placed in a pool. Assets are placed in their respective pools, and class 1, 2, 3 assets follow the pool system. Class 1, 2, 3 depreciable assets follow the pool system. Class 4 and 5 depreciable assets are placed in a pool of its own separately from other classes of that class or any other class. But so you can, that's what we just did. You can either maintain them as a pool like pool 4 and 5, or you can make them different, like factory buildings and office buildings. That's what it means. Then only that part of the asset which is used in the production of the income shall be placed in the pool. So only an asset that has been used by the business will be what? Placed in the pool. So basically that's it for question 2. So simple and straightforward. In case you have any questions, you can drop it in the comment section, and I'll bring in more explanations. All right, let's move to question 3, what almost everyone has been waiting for. And it is also the easiest. Right? It is also easy. It's also easy. As far as you've been able to understand question 1 and 2, question 3 should be easy. So NASA Limited commenced business on 1st October 2017. You see, 1st October 2017. The basis period for the first year is what is going to change. It's going to be more of October, November, and December, 3 months. It's not going to be the full year. Hmm. All right. So NASA Limited commenced business on pause. NASA business comment NASA commenced business on 1st October 2017, preparing accounts to 31st December each year. Each year. Accordingly, the company has the following extracts from its financial reports on non-current assets. So they have purchased office on the year 2017. They purchased what? Office furnitures and fittings costing this. Purchased office air conditioners at cost of this. Company bought a land costing this. Office building at cost of this. Purchase a computer at the cost of this. Purchase office photocopier at the cost of this. And then purchase a television set. So let's do, okay. Purchase a television set for the office, this, and then bought a 4x4 vehicle, 7 passenger seat. Remember I told you that for a vehicle to be considered as a non-commercial, it should have what, 13, at least 13 passengers. But this have what, a 7-seater distance, so it will still be what, considered as a what, a non-commercial. So yeah, so non-commercial have less than 13 seats, but commercial have what, more than 13 seats. So since this have a what, 13 passenger seat, it is what, a non-commercial. Purchase the file cabinet for this. And in 2019, it exchanged the vehicle bought in 2018 for 4 plots of land. The value of the plot of land agreed with the land owners was 200,000. The exchange was deemed satisfactory to both parties and documentation was carried through. So it exchanged the vehicles. The vehicle bought in 2018 for 4 plots, right? So that's 200,000, and then paid for a trademark costing was 15,000, which was license for 10 years. Purchased a business that resulted in goodwill of 100,000. The company decided to amortize the goodwill over 20 years. Goodwill would not even be part of our calculation, so it is not really needed. Then bought a home used motor vehicle at 70,000. Purchased office computers for 5,000 the year 2020. Purchased trucks and trailers for 50,000. Sold some office furniture for what? 30,000. So they said we should calculate the capital allowance claimable for 2017, 2018, 2019, and 2020 year of assessment. Right. Then the B is what? A class 1, 2, 3 depreciable asset owned and employed by a person during a year of assessment in the production of income from a particular business shall, at the time the asset is first owned and employed by the person, by place, may be placed in a pool with all other assets of the same class owned and employed by that person in the business. What are the implications and taxation rules governing the above statement? So let's quickly dive into this and let's move on. So now, in the year 2017, this was what they purchased. They purchased what? Office, furnitures, and this. So first, let's first identify our destinies and then move on. So first, we identify um so computers will be in what? Class 1. Office building will be in what? Class 4. Um then land doesn't depreciate, so we don't apply any capital allowance to it. The office furnitures and fittings. Why are people calling me pa? All right, so office furnitures and fittings will be in pool 3. Then air conditions, of course, will also be in what? Pool 3. Then photocopier will also be in pool 3. So now let's look at it. So in the first year, right? This was what our value for pool 1, which was the computer, 1,500, and then we have it here, right? Then we didn't have any class 2 assets, so no class 2 assets is here. Then class 3 assets is going to be it's going to be 40,000 plus this 20,000 plus this 2,500, giving us 6,000, 62,500. That's what we have here. Then we have office building at a cost of 700. So it will be down here. I created a different table for that one. 700,000. That's what we are having here. So remember, I told you that we will be more looking into what the basis period for the first year. And the basis period for the first year is what? On 1st October to 31st December. So October has 31 days, 30 days of October as October. So 30 plus 30 days of September. April, June, and November. All the rest are 31. October is 31, sorry. Ish. 31 plus November has 30 days of September, April, June, and November. And then December also have what, 31. All the rest are 31, except February alone. That's the same thing here. So we are going to get a total of 92 days. Our basis period for the first year is of 92 days. That's what we're having here. So that's basically it. So we apply our capital allowance, 40% on this. 40%, 30%, 20%, right? We apply them, right? And here I told you because it was used within 90 days, when you apply 40% on this, we'll do it like this. So 40% times 1,000 times 92 over 365, right? Then you get this. Then here we didn't have any class 2 assets. So you have to do 20% times 62,500 times 92 over wait, 365. Then do it, you get this. Remember, all the figures here are round to the nearest real number. All right, so that's what we get here. All right, so let's move to the buildings. So that one too, 10% of this times 92 over 365. That's the same thing we get. That's the same thing we are going to get here. So now let's move on. We are done with 2017. So in the year 2018, we purchased a television set of 8,500. Right, let's re-identify our destiny again. This is going to be input 3. This is going to be input 2. And this is going to be input 3, right? So since we've been able to identify them, 3, 2, 3, nice formation. So in 2018, we add our additions, right? Nothing in input 1 was purchased. So input 2, we bought what? A 4x4. And then I told you, it is less than 13 passengers. So it is a non-commercial vehicle, which have a cap of what? 75,000. That's what the law says. So that was the 75,000 we brought here. Then 3,500 plus 2,000, 5,500. That's what we have here. So here's what we calculate. When we add it to the previous year's written down value, right? Oh, I didn't do the written down value. Let me do it. So I'm doing the written down value. Sorry. Don't forget. 1, 3, 4, 9. Then dash. And then 65 minus 3, 1, 5, 1. And we're going to get 5, 9, 3, 4, 9. All right. So now this is it here. Then the year 2018, no additions. So we calculate this. Remember the next years will be full years, not 91 days, right? So we calculate capital allowances on them. So 40% on this is straight, not times anything, only 40% on this right? So the next year is going to be only 40%. So for here, 40% times 1349, and then not times any days or whatsoever again. So you do the same thing for this one, 40% on this, 30% on this, then 20% on this, right? So we now what come and then get our capital allowances here. Know that we are only looking for capital allowances, but at the end, if you don't subtract and get your written down values, you wouldn't be what able to compute for the next year, right? So all right. So now this is our written down value after subtracting the listing. So in the year 2019, let's look at what happened. So in the year 2019, it was exchanged the vehicle. It exchanged the vehicle bought in 2018 for 4 plots of land. The value of the plot of land agreed with the landowners was 200,000. The exchange was deemed, so meaning that asset bought, you remember the vehicle bought was placed in pool two. So since it was exchanged and it is being exchanged for a land which is not, which capital allowance cannot be applied on, we assume that it has been sold. Supposed to be 200,000. All right, so now this is it here. Uh, so we exchange the this thing for 200,000. So that's what we place in here. And then no, wait, let's look at the land and building side for the side of 2018. Okay, nothing was done in there. So we just compute our capital allowance for the year 2018. That's it. And it's only on the office building, right? So 40% on this. Why didn't you write? Okay, still 10% on this. It's still on the first. So let me try and bring down the written down tab. All right, and here becomes dash. Okay, so this is it for the land and building side. And then now in the year 2019, they exchanged this thing that they bought for this thing. So that's it. We assume it has been sold, disposed, and then now we calculate our capital allowance. So calculating the capital allowance will what be 40% on this 809. Right, 40% on this 809. When we find 40% on this 809, we are going to get when we find it on this, we are going to get 40% is going to be this is going to be 323.6. So let's say 324. right? So this 324 is going to be our normal capital allowance. But when we subtract 809, so 809 minus 324, we are going to get 485. Right, we are going to get 485. And 485, according to the law, is what? It's lesser than 500. So, where is it? So here, so if at the end of the base pair, the written down value of the district is less than 500, then we add it as what? An additional capital allowance. So that's what we are doing here. So, so, um, so we bring, that's why we are bringing all these 809 as a capital allowance here. Because when we subtract a capital allowance from it, what will be left is what? Less than 500 Ghana cedi. So we bring all of them as a capital allowance. All right. Then the building now, after subtracting this from the amount we had at the disposition of it and the written down value, we are getting nothing. So there will be nothing for what? Capital allowance. That's why you're having 00 here. And also for pool 3, right? Pool 3, we didn't really do anything sort of pool 3. So we continue with the same 20% on the written down value. So 20% of this is giving us this, right? So once we subtract uh, the capital allowance from the written down value here, we are going to get a new written down value, right? So that's it here. Now, we what? Paid for a trademark in the year 2019. So here, our building is here, 2019. Sorry, capital allowance. So, so in 2019, what happened was that our still capital allowance to be calculated on the cost, which is 10% times the 700,000. Now we are still getting 70,000 here. And then we getting a written down value of 542,356 minus 70,000. So 472,356. Right. Yeah. Then now we purchase what? A patent or a trademark for 15,000 for 10 years. So this is it here. And then trademark will be what? Based on the estimated useful life, which is 10 years. So this divided by 10 is going to give us this. So 15,000 divided by 10 is going to give us 1,500. So our capital allowance for this year is this. So the year 2020, okay. I think I did some mistakes when I was typing them, so I'm just trying to correct them. All right. So In the year 2020, this is what we purchased what a home use motor vehicle at cost of what 70,000, right? And then we purchased office computers for 5,000, and then purchased truck and trailers for 50,000, and then sold some office furniture for what 3,000. So let's indicate this. So home use motor will be in what pool two, purchase office computers will be in pool one, truck and trailers pool two, and then office equipment is what in pool three. So meaning that in 2020 we didn't do anything of um pool four and pool five of sorts. So let's just quickly do the same thing. So still the 10% is what based on the initial amount, which was 700,000, then we are what getting 30 and 70,000. So once you subtract from the written down value, you are getting what's this. And then the patent two is what on the estimated useful life. So 15,000 again, 1,500 again will be subtracted from the will be grant sorry 1,500 again will be granted as what a capital allowance. And now since we want just the written down value, when we subtract it from the old written down value, yeah, we are going to get our new written down value. So um, basically that is it for this one. So now, because some adjustment needs to be made, let's go back onto pool one, pool three, pool one, pool two, pool three table. So on pool one, pool two, and pool three table, this is what we are having here. 2020, right? We added motor vehicle and then truck and trailers pool two. So 70,000 plus 50,000 giving us what 120,000. That's what you're having here. And purchase computers 5,000, which is what added in pool one. Then we sold equipment what 3,000, which is in what pool three. So we add and deduct anything before we apply a capital allowance. So now after doing everything, because in the year 2019 we granted what 809 all as the capital allowance. So now our new balance here was what 5,000. So we applied what our 40% on this 5,000. We are getting this 2,000 as our what capital allowance. Then after addition of this 120,000, because we sold our motor vehicle, we exchange it for a land. We started everything again at 120. Then 30% of it is giving us this 36,000. Then now we sold some equipment. So our written down value was 41 times 503. Then we subtracted our disposals from it, what we sold. Then it was left with this. Then we applied our 20%, and then we had this, right? So so now, after taking out our capital allowances, this is what we are having, this is what we are having, this is what we are having here, right? So now, they're asking us to capital allowance claimable. So 2017 year of assessment, capital allowance is going to be equal to this plus this, right? So this plus this. Then we are going to get this. Then our 2018. And our 2018 is going to be this. Plus this. Then our 2019 is going to be this. This. This plus this. Then our 2020 capital allowance is going to be this. What this? All right, so this is going to be the capital allowances for each of the years of assessment, respectively, right? So 2017, 2018, 2019, 2020 year of assessment. All right. So let's talk about the B part. So the B is talking about assets, a class 1, 2, 3 assets owned and employed. Talking only about class 1, 2, 3. So we know that in the class 1, 2, 3, right? In this system, in this pool system, the identity of the asset is lost. Right? Once an asset is being placed in this pool, the value or the identity is lost. Capital allowance is calculated using the reducing balance method. And when an asset is sold, the consideration received by the person during the year less the depreciation of the basis at the end of the year, right? So it's included in calculating person's income for a year of assessment from a business in which the depreciable asset was sold. Then written down value of 500 cedis and below are granted as capital allowance. Then only the part of the assets which is used in the production of the income shall be placed in the pool. Then where the asset is in a pool of depreciable assets of a person are all sold or realized by the person before the end of a year of assessment, the pool is dissolved, right? We found some this thing where they exchanged the vehicle for land and then everything was what? Zero, right? So an amount is included in calculating the person's income for the year. Income for the year calculated in accordance with the formula A minus B, or capital allowance is granted to the person for the year calculated in accordance with the formula B minus A. So when you make a profit, right, there is what this thing granted. When you make a profit, which is the A minus B, your destiny is being calculated or added to your profit. Whilst when you make a loss, you are being given what? A capital allowance, right? Where A is the consideration received by the person during the year of assessment, and B is the sum of the written down value of the pool at the end of the previous year of assessment. Amount added to the depreciation basis of the pool during the year of assessment. Okay, yeah. So the written down value of the pool at the end of the previous year of assessment and amount added to the depreciation basis for the pool, year of the pool during the. So basically what this means is that when the person make a loss, the loss is being given as a capital allowance, and when it is in profit, the person is being taxed on the profit, right? So basically that is it for tutorial set 3. If you found this video helpful, kindly give me a thumbs up and also give me a comment if in case you didn't understand any concept. I will come there and then re-explain it to you well. Thank you very much. Have a blissful weekend. Bye.